everyone, this is Purti, and today let's talk about patterns and how to trade them. In my previous episode of Trading 101, I talked about how supports and resistances can be used to place your trades. In this video, let's talk about a few more patterns which are paramount to making you money in a short time frame. Learning to read the technical charts help you develop a thesis and support in timing the market. Of course, no one can actually time the market, but a proper entry and exit points backed by technical charts give you a higher probability to place a winning trade. Keep in mind it enhances the probability but does not guarantee a winning trade. In this video, you'll learn about the most effective patterns that act as trend reversals. So, starting off, the double top pattern. The double top chart pattern is an indication that the prevailing trend may reverse in the short or long term. It usually occurs towards the end of a bullish market. The price formation looks like two peaks that occur one after the other. There are three parts to this pattern: the first peak, the second peak, and the neckline. The double top pattern tells an investor, trader, or an analyst that the buyers in the market are prevailing, and as such, the demand is overtaking the supply up until the formation of the first top. It causes prices to rise. The trend is then reversed, and the sellers in the market begin to prevail, subsequently, with the supply overtaking the demand. As the supply surpasses the demand, the prices begin to fall. It creates the neckline or the price valley. Following the valley, the bulls or the buyers in the market begin to dominate again, and the prices begin to rise. When the traders notice that the prices are not rising beyond the level reached by the first top, the bears or the sellers may begin to dominate and begin to lower the price levels. It causes the formation of a double top. Should the prices drop beyond the valley, it is generally a bearish signal. Two factors that allow for analysts or traders to determine the existence of the double top pattern are the volume and the time between the peaks. When looking at the volume, it is beneficial to note that the build-up of the price level reached on the first peak can be attributed to increased volume. The fall to the neckline occurring thereafter can be attributed to low volumes. The second attempt leading towards the second peak should also be on low volume levels. Let's take a look at some examples. I'm using the 5-year 1-day chart for all the examples here. For the stock AA, there has been a continuous bull run for several months in the year of 2017. In Jan 2018, we see a peak with high volume. The bulls lose steam after this peak and the bears dominate, forming a neckline at 44.06. Notice the false breakout at 62.35. It could have been that the stock would continue to rise had the volume been significant. But we see a declining volume compared to the previous peak formed. The double tops are at 57.23. Notice that when the price breaks the neckline or the support line, the volume again increases, meaning that the bears are currently dominating to bring the prices down. The volume again declines, meaning the bulls are not able to push the prices up. We see a consolidation for a few months, after which we see a sharp decline in the stock price. For the other stock, RRC, notice that it has been on a bull run for almost the entire of 2018 before forming the double top pattern with the peaks at 18.07 and the support line at 15.17. Although if you notice, there are other double top patterns which you can see. One thing to note is that not every double top pattern leads to a trend reversal. You have to see this pattern along with the rising volume for peaks and rising volume during the breakdowns. You should be careful while placing your trades. The most ideal trade is to short the stock when the stock breaks down the neckline or sell the stock if you are long on it. The easiest way to remember this pattern is to remember the letter M for murder, as the letter M has two tops just like in the double top pattern, meaning a bearish signal. Next is the double bottom pattern. The double bottom formation typically occurs at the end of a downward trending or a declining market. The double bottom is similar to the double top, but the key difference between the two can be seen as the inverse or the negative relationship in the price. In contrast to the double top, the double bottom price formation comprises of two peaks or prices occurring at a similar minimum level and are separated by a peak known as the neckline. When the prices rise above the neckline, it serves as a confirmation of the bull signal and may indicate that prices will likely continue to rise. As with the double top, timing and volume also play a role in the analysis and confirmation of the double bottom. Let's take a look at an example of the stock SHOP. Here the neckline is at 462.84 and the bottoms are at 336.5. Notice that the volume is increasing when the resistance or the neckline is broken, indicating a bullish signal. The most ideal trade is to get into a long stock position when the stock breaks out of the neckline or the resistance. The easiest way to remember this is to remember the letter W for win, as the letter W has two bottoms just like in the double bottom pattern, meaning a bullish signal. Now let's look at another reversal pattern, the head and shoulders pattern. It takes the shape that looks like a human head with shoulders on either side as shown in the chart. This pattern formation has three specific areas, two shoulders and one head. Take a look at this chart. To the untrained eye, it can look like a jumbled mess, but if you spend some time studying it, you can see that this pattern looks awful lot like a head and a pair of shoulders. Volume is a very important factor to look at when one studies this pattern. Volume is highest and often expands on the left shoulder as the uptrend continues and more investors want to get in, whereas it is the lowest on the right shoulder as investors sense a trend reversal. This low volume is often considered a strong sign of reversal. In the head portion of the pattern, the volume lies somewhere between that of the left and the right shoulder. Let's look at an example of Twitter. Number one, the left shoulder. To start off, the price rises to a new high and forms a peak at 43.56. That is followed by a price dip. Here the stock's price has been rising on a pre-existing uptrend. When the bulls run into resistance that's too strong to immediately overcome, you see a peak. Buyers begin to sell, shorts begin to sell, and the price falls. That's the first dip. Neckline is at 40.31. Together, the rise, peak and the fall in price form the pattern's left shoulder. Number two, the head. After the price reaches the bottom of the first dip, it moves up again, peaking higher than the left shoulder at 45.85. Shortly after making a new high and a peak, there are no new buyers and the sellers begin to sell again. The stock's price slides lower again. This forms the head or the second peak of the pattern. It's the top of the bullish trend. After this peak, the second dip forms. Number three, the right shoulder. In this final act, the price rises once more near the level of the left shoulder before it declines again for a final time. The Twitter chart is a perfect example. Both shoulders top out at the same level just below 43.56. With the right shoulder failing to break out to new highs, the bears have won the battle for now. The stock slides lower, breaking through the support level, making a lower low. It's a confirmed breakdown. Now let's look at the inverse head and shoulders pattern. This is simply the inverse of the head and shoulders, or the head and shoulders turned upside down. Everything is the same, but it looks more like a deep gorge with a shallow gorge on each side instead of head and shoulders. Let's take a look at the stock Zynga. The bears dominated heading into November, but the bulls begin to push back. That drives the stock up to form the first shallow dip at 3.58. The stock is in a downtrend, making lower lows on each dip, In late November, there is a support in the form of a second dip at 3.36 that actually ends up as a double bottom. This is the head. In the late December 2019, the pattern confirms a reversal, putting a higher low for the third dip. This final dip completes the reverse or the inverse head and shoulders pattern. The pattern is nearly identical to the standard head and shoulders, but the whole thing is flipped upside down. The first two dips appear to be part of the bearish trend. Just like the regular head and shoulders, it's the third dip that completes the pattern and confirms the trend reversal. As mentioned before, not every double top or head and shoulders pattern leads to a trend reversal. These are just indications of trend reversal to keep an eye out for. These patterns are useful only when you view them with the volume, provided that there are no additional catalysts. Keep in mind that the patterns which we just discussed can morph into reverse pattern if a strong catalyst comes for that stock. For example, a double top doesn't necessarily mean a breakdown beyond a neckline. It could rebound and form a triple top and eventually start running. Or the inverse head and shoulders could be viewed as a bearish trend continuation pattern and its breakdown. One way to be sure is to invest only when supports and resistances of these patterns are broken. That is, look out for confirmation of the patterns. Barring any other catalyst, there is a good chance all the stocks follow these patterns as these patterns are back tested. Let me know what you think of this video and post your questions and comments below. Keep in mind that this video is for information purposes only and should not be interpreted as any financial advice. If you like this video, don't forget to like, share and subscribe and hit the bell icon for more videos on financial literacy. Thanks for joining me today and I'll see you all in my next video. Bye-bye.